Welcome back to Wall Street Confidential. Here we are revisiting a topic. Hey, we touched on this about 10 months ago, and it has to do with the lack of transparency at our banks. And you'd think that by now we'd have some answers.
Well, Farnoosh, I mean, look, even this morning, E-Trade, $3 stock, they came out and they said that there had been a dramatic cut in their the amount of money they're borrowing. But what's determining E-Trade is home equity loans and their big portfolio. E-Trade has been probably the most forthcoming in telling us about their portfolio. So it's a good example to use. You know, the headline was, I think, sent you in misdirection. The banks that we trade every day, though, Wachovia, Citigroup, we really don't know anything about what they own. My fear is that they don't know anything about what they own. I mean, witness the fact that Erin Callum was fired at Lehman Brothers. I think she had very little knowledge of what their portfolio was in. And the reason is because, and this is 10 months later, we still don't know what's in when you hear mortgage-backed securities. We don't know what's in them. Is it home equity? Is it B? Is it A? Is it subprime? Is it FICO 700? Is it FICO 500? Is it California? Is it Florida? What vintage it is? We don't know. And the losses, $400 billion, is starting to figure out that maybe more than half of the loans, the mortgage loans, have gone bad, which is kind of cataclysmic from 2005, 2007. I don't really believe that. But without any transparency, we can't price these bonds. If you can't price the bonds, then what happens is that you get companies that endlessly have to raise capital because they may have very big losses. As it is, a Wachovia, Bank of America have losses on individual mortgages that they've made to homeowners. But a lot of these banks, I think, have been reluctant to look deep into these. AIG, too, by the way, very reluctant to look deep in. One, they didn't have to. The government doesn't seem to require that much disclosure. But more importantly, MBIA and AMBAC had pretty much guaranteed the pricing of these. And I think a lot of the banks were relying on that and to make it so that they didn't need to look through themselves. They could always say, well, listen, it's insured by MBIA. Well, obviously that's going away. So the fundamental issue here is twofold: house price depreciation and what's in these securities. And without knowing, I think you're throwing money away if you buy Wachovia, Bank of America, or Citi, or Washington Mutual, or Nat City, or Huntington Bank shares. I think you're throwing money away if you buy Key Bank or Sovereign Bank. You're just throwing it away. At BB&T, Marshall and Ilsley, you're throwing the money away. And First Horizon, and people continue to throw their money away. And I think it's really a dangerous game.
I have a mortgage with First Horizon.
Well, remember, your mortgage is up to whether you pay it or not. It doesn't mean you want to.
Still.
Right.
I know,
it could pull everybody down.
And so the fear is what? These banks, some of them might go away?
I think so. I mean, I think, you have to start thinking the unthinkable. In 1990, I had money in two banks that folded. I mean, they folded. Yeah. They closed one day as one bank, and they opened one day as the next. And I certainly didn't set out to put money with banks that I thought was at risk. Many of the banks that we think are big blue chip banks aren't. Mm-hmm. And who the heck knows what's in Wachovia's portfolio? I mean, they were still writing bad loans recently. Bank of America, I think that we will look back, and this is a prediction that I'm saying, but we will look back and we may think that Countrywide sank Bank of America and made it so it had to sell itself.
All right, thanks so much, Jim Cramer. We might be visiting this topic again in a few months. Hopefully not. But
maybe we'll get some disclosure, but there's no pressure from the SEC, so why bother?
All right, this is Wall Street Confidential. Thanks for watching.